Hello friends, let's start with the next topic, that is past adjustments after closing the books of accounts. Now it can happen that the partnership deed was there, you had everything in place, you had your interest on capital, you had your salary, remuneration, interest on drawing, everything was decided, okay, and your P&L appropriation was prepared. So if you see the P&L appropriation, you had your net profits transferred, you had interest on drawings, you had your salary, commission, you have interest on capital, and then you had transferred to reserve. And the final figure, which is the capital amount, which is going to be the amount of profit which is going to be transferred to the capital account. So ultimately this is the purpose of doing the P&L appropriation. Now what happened is that by chance you missed out to provide for interest on capital, or you forgot to provide for interest on drawings. So what will happen? Because you missed out the interest on drawings or you missed out on the interest on capital, you would have either given more profit, okay, because you missed it out, right, in the appropriation. So you would have distributed more profits, or you would have given less profit because of the mistake you have done. So what happens now? It is time for correction, because the books are already closed. That means we have already given the profits based on the profit sharing ratio. Clear? Now just go to page number 2.52. We'll follow the steps which you have to do to rectify this mistake. So first step is that we prepare this analytical table. The analytical table, you will have your particulars where you will mention the interest on capital, interest on drawings. See, we know that interest on capital is actually a expenditure for the firm, and interest on drawing is an income for the firm. So when we talk about IOC or interest on capital, it has to be paid to the partner. So we will credit it to the respective partner which is missed out. So you can see under A's capital, B's capital and C's capital, it is shown on the credit side. And interest on drawing, on the other hand, is going to be collected from the partners which was missed out. So we'll put it on the debit side of each partner, A's capital, B's capital and C's capital. So this is how we will show the analytical table. So once you have done the same method, you can go to step number 4, where you repeat this process for any other expenses. For example, if you missed out even salary, okay, salary had to be paid, so that you can show it on the credit side. Okay, then you find out the balance. That is, either your debit side should be more or credit side should be more. You find out the balance. Then you divide the profit and loss among the partners in the profit sharing ratio. I am telling once again, if you would have not considered this, obviously you would have paid more profits because you forgot to provide for salary and interest on capital. Let's assume, for example, 1 lakh was the net profit and you forgot to give IOC of 10,000. So instead of distributing 90,000, you have distributed 1 lakh. Because 10,000 you forgot to provide. So now when you distribute this 1 lakh, in what ratio would have distributed? Obviously the profit sharing ratio. So what we have to do is we have to reverse that. How much? The 10,000 portion alone. Because the 10,000 portion alone is wrongly given to the partners in the profit sharing ratio. So we will have to recover that. So we'll put that on the debit side. And IOC, which was not provided, we'll put it on the credit side. When you see this problem number illustration 38, on page number 2.53, you can see that you can directly go to the adjustment table where you have the interest on capital, which is 10,000 had to be given to P, 5,000 had to be given to Q. Okay, 10,000 is missed out and 5,000 is missed out. So obviously what has happened, this entire 15,000 was missed out and it was given by mistake as profit to the partners in the profit sharing ratio. And we know that the profit sharing ratio is 50-50. That means that 50,000 would have been distributed as how much? 7,500 and 7,500. So that means instead of 10,000, P has got 7,500 and Q instead of 5,000 has got 7,500. That means P has to be still given 2,500. So it is a 2,500 credit, and Q we have to recover 2,000 because we have paid him excess already. So 2,500 debit. So what is the entry will pass? We will debit Q's current account and credit P's current account 2,500. It is as simple as that. So these are the past adjustments. Okay, we can see one more example, illustration 39, to get some clarity on this. What happened? The profits of XYZ was 1.5 lakhs and the ratio was 2:1. But the partnership deed was silent. When the partnership deed is silent, that means it has to be shared equally, right? So this 1,50,000 should have been actually given as 50-50-50, But how did they distribute? 60, 60 and 30. So we'll put the column adjustment table. We have profits already credited for XYZ, which is 60, 60 and 30. And then profit to be credited is going to be what? Actually it should have been equally. So 50, 50, 50. So the difference is going to be 10,000 for X, which is excess paid. For Y, again 10,000 excess paid. And for Z, 20,000 short. So who has to give now? Yes, we have to collect from X and Y. So we will debit X capital and Y capital with 10,000 each. And we have to pay for Z. So we will credit Z's capital with 20,000. It's just as simple as that. You can go to one more illustration, illustration 41, where you can see that interest on capital is actually 16,000 and 14,000. Okay, 16,000, 14,000 and 10,000. Totally 40,000 interest on capital. And interest on drawing on the other hand, 2,500, 3,000 and 1,500. So how do we get this interest on capital? We have to actually find the opening capital in the previous method, where we have to do a reverse working from the closing capital, arrive at the opening capital and apply the percentage on interest on capital. So for this you will calculate the IOC, then you will calculate your IOD, and if you see the difference, that is 40,000 IOC should have been given, 7,000 IOD should have been collected. That means 33,000 you have given excess profits. In what ratio? In the ratio 2:1. So we will split that 33,000 in that ratio 2:1, and we will see the difference. So you can see that Asha's capital, the net effect is 300 credit. Okay, she has received, she has to be given 300 extra. And Nisha's capital, if you see 2,200 debit, we have to recover from her. And Disha 1,900 credit, we have to give Disha. So totally, so Nisha's capital account will be debited with 2,200, and Asha's capital with 300, and Disha's capital with 1,900 credit. So this is how we will pass the journal entry. So the workings will end with the journal entry only. Okay, so you have to prepare this adjustment table. Okay, for each partner you have to put the column and you have to find out the difference in the amount and then pass the journal entry based on the net effect. So it's a very easy concept if you understand the previous all concepts. For understanding sake, you can even work out most of the illustrations which are there. They are very easy and you have to just apply yourself and you'll be able to solve it. I think if you solve 49, it's one of the very nice problems. So you can just solve 49. It has all the situations in that. Wrong interest on capital is there, wrong profit share is there, everything is mentioned over there. So you can work out that problem. It will be very easy, if you are able to work out that illustration 49. Suppose the adjustment entries are going to be passed. You need not prepare an adjustment table. So you can go to page number 2.62 where the entries are being mentioned. So adjustment entries for the item which are to be credited to partner's capital account will be P&L adjustment account debit to partner's capital account, P&L account adjustment account debit to partner's capital. If the adjustment entries have to be debited, then partner's capital account debit to P&L adjustment. And so the net profit and loss due to the above adjustment will be P&L adjustment to partner's capital for profits. For loss, partner's capital to P&L adjustment account. So the past adjustments, you should remember that we have forgotten to give some expenditure, and by mistake we have given the same amount as profit in a different PSR. So that is why we have to reverse the PSR and give the expenses, and if anything is left only we have to distribute. Mostly it will not be there because we are already found out the difference, and that is how we are reversing it. So keep this in mind. But if there is a change in PSR, then you have to rework and give it in a different PSR. So that's the only challenge you might be facing, for which illustration 49 will help. Thank you.